with a very quick revision of partnership accounts. It's more like a last day revision for this chapter in CA Foundation. Very important chapter. So let us not waste time and let us directly start the revision. So the main objective in this chapter is to do the accounting for the event of partnership the event of admission or retirement or death or change in the firm's PSR. Alright, that's my main objective. So objective is not to do the final accounts or to find the profits for a particular period. It is only for doing the accounting for the event of admission, retirement, death or a change in the firm's constitution being the PSR. Okay? So there are many parts and subparts in this chapter. The first part in the chapter is a simple introduction to the partnership account. So it is a little different from the final accounts of a sole trader, and so this part of the chapter deals more with profit loss appropriation account, that is different as compared to a sole trader, and it talks about interest on partners capital, interest on partners drawings, interest on loans, etc., etc. So it says that if there is no agreement between the partners, in that case there will be no interest to be paid to partners capital, because agreement has to mention specifically that interest has to be given to partners. Only then will the interest be payable to the partners on their capitals. Also, if there is no agreement, then a 6% interest on loan will be paid by the firm to the partners, but this has to be a loan. Alright, if there is no agreement, then the partners will share profits and losses in equal proportion. The partnership agreement has to mention a particular PSR for the partners to share the profits in that respective PSR. If there is no agreement, then the partners share it equally. Then there is no remuneration to be paid to any partners if the agreement does not exist. If the agreement mentions that partner A, partner B, partner C, as the cases, are going to get X remuneration or Y remuneration, only then will the remuneration be paid to the respective partners. Then talking about the profit loss appropriation account, how does a profit loss appropriation account look like? So profit loss appropriation account is nothing but a simple extension of the profit loss account. Whatever things comes in the profit loss account, the same purpose is for profit loss appropriation account. Profit loss appropriation account is also going to give us the profits only. So profit loss appropriation account is a simple extension of profit loss account, just that the expenses which are pertaining to the partners find place in the profit loss appropriation account. For example, if there is a rent paid or it is some station expenses paid, this is not pertaining to the partners, it is pertaining to outsiders being the vendors. Those expenses are going to appear in the profit loss account. But any expenses which are pertaining to partners, for example salary paid to partners, commission paid to partners, these are firm's expenses. But since it is paid to the partners, they will find place in the profit loss appropriation account. Other things that come in profit loss appropriation account is the interest on partners capital. Whatever interest the firm pays to the partners, keep in mind it is the income for the partners. It is an expense for the firm, so it should come in profit loss account. But since it is pertaining to partners, it will come in the profit loss appropriation account. Similarly, salary to partner, commission to partner, all these are simple remuneration paid to partners. These are expenses pertaining to partners, will come in the appropriation account. Similarly, there is something called as transfer to reserves. The partners may decide internally that every year 30% profits or 40% profits will be a part of the firm only. That means they cannot be withdrawn. In that case, the firm will appropriate 30% profits from the profit loss appropriation account and keep it to a fund. These profits cannot be withdrawn. The remaining partners are open to the remaining profits are open to the partners for their withdrawal. Similarly, the interest on partners drawings, whatever drawings the partners have made, if there is a clause in the agreement that the partners will have to pay interest to the firm, then on those drawings the partners will pay interest to the firm. It is the firm's income because of which it comes on the credit side, and since it's pertaining to partners, it will come in the appropriation account. And obviously whatever is the profit that we earn, the firm earns, that profits will flow in the profit loss appropriation account, and the balancing figure will ultimately be transferred to the balance sheet, but before that it goes to partners capital account in their respective PSR, and from the partners cap account it will come in the balance sheet. This is how the profit loss appropriation account looks like. Please take care that drawings are not a part of profit loss account, or it is not a part of the appropriation account as well. The entry for drawings is drawings account debit to cash, and drawings is transferred to partners capital. Common mistake people do is that they transfer drawings to profit loss appropriation account, or they transfer drawings to profit loss. Keep in mind, the interest on drawings comes in the appropriation, the drawings do not. Drawings are directly transferred to capital account. Then we also talk about the types of capital, that is fixed capital and fluctuating capital. In the case of fixed capital, we maintain one more account, that is the current account. All the transactions, all the entries that pertain to capital account will now be transferred to current account, and the capital account will only and only show the partner's capital, because of which the amount remains fixed, and that's called fixed capital. In case of fluctuating capital, all transactions pertaining to partners capital are transferred to partners capital account, because of which it keeps on fluctuating, and that the balance keeps on fluctuating, and that is why it is called the fluctuating capital. These were all the important things in the first part of this chapter, being introduction to partnership. In the chapter's second part, that is goodwill, in chapter second part we discuss about the importance of goodwill and the way we compute goodwill, the methods to compute goodwill. Goodwill is nothing but the firm's reputation, and a self-generated goodwill is never computed, because there is no entry to be made in case a firm generates goodwill on their own. So entry or accounting impact will only come as far as the purchased goodwill is concerned, or goodwill which is adjusted among the partners capital during admission or retirement or death. Now, how do you compute goodwill? The first method is an average profit method. Within average profit method, it's either simple average or weighted average. In case of simple average, it is profit plus profit plus profit divided by 3, or number of years depending on the data given. So if there are 5 years, 5 years profit divided by 5, you will get the average profits. In case profits show a rising trend, or the question specifically mentions that the profits have to be computed as per weighted average, then in that case you have to compute the weighted average profits, in which case you have to assign weights to the profits. The weights will be 1 in 1, 2, 3, 4, 5, highest weight to the most recent profits. Sum of the products upon the sum of the weights will give us the weighted average profits. Then super profits. Super profit is nothing but the difference between the actual profits and the average profits. Alright, whatever is the difference, this is called the super profit. You may also be given something called as a normal rate of return, NRR. You have to apply NRR on the capital employed to get the average profit. Compare that to my actual profits. The difference is super profits. Super profits is not goodwill. Super profits into number of years will be the amount of goodwill. Then comes annuity method. In the case of annuity method, the super profit will be multiplied by the annuity factor. Annuity factor will be given to us in the question. So multiply super profit into annuity factor instead of number of years, and you get the super profit. You get the goodwill as per super profit method by the annuity sub method. Then we have the capitalization method. Here we compare the capital employed with the actual capital, or the average capital employed with the actual capital employed, and the difference is the amount of goodwill. The average capital employed is super profit into 100 upon NRR. This will give us the average profit. Average capital employed. Once we get the average capital employed, compare that to the actual capital employed, and the difference has to be goodwill, and that is how you compute goodwill as per the capitalization method. The capitalization method can also be used on the average profit rather than super profit. The base is changing, the method and the formulas will not change. So I will use the base of average profit, compute my capital employed, and then compare that with my actual capital employed. The difference is my amount of goodwill. If my capital employed is less than the industry average, then the difference is the goodwill amount. Moving on, there's also something called as hidden goodwill. Sometimes the question will not give the goodwill directly. You will have to yourself find the hidden goodwill amount. How do you compute that? Partners capital into reciprocal. What do you mean by this? For example, if the new or the incoming partner share is say 1/5, that means the remaining partner share or the old partner share appears to be 4/5. Alright, so whatever is the partner's capital account, so that capital, the total capital into the reciprocal of the remaining partner's capital, that is in my example 1/5 is the new partner's PSR, that means 4/5 is the remaining share, that is 5/4 reciprocal. So capital into 5/4, this will give us how much capital should be of the firm. Then you compare that to the actual capital, that is total capital of A plus B plus C, assuming C is the incoming partner. So how much capital should be the case compared to the partner's share? Compare that to the actual capital, and the difference is going to be the amount of goodwill. This is how you compute hidden goodwill. In case the question simply mentions compute the value of goodwill and they don't give the method, then in that case you may have to compute goodwill like this, or the question will simply say this is the partner's new PSR, that is the amount of capital he is bringing. Compare that and find the value of the hidden goodwill like this. So the firm's capital into reciprocal of the remaining partners, compare that to the actual capital of the firm, and the balancing figure becomes the value of hidden goodwill. That is as far as goodwill computation is concerned. Then we have chapter's third part, that is admission of partner. So what is the flow of the things in which the sums have to be solved? First, you transfer the balance of the partner's capital in their respective capital accounts. Then you search for any existing reserves. These reserves pertain to the old partners. Therefore, it should go amongst the old partners in the old PSR, because these profits were earned when the incoming partner was not there. So they belong to the old partners. That's why I transfer them to the partner's capital in the old PSR. Reval profit or reval losses will be given to us in the question. If there is if there is any increase in the value of the assets, that goes in my reval account credit side. If there is a fall in the value of the assets, it comes to reval account debit side. Balancing figure is reval profit or reval losses will go in the partner's cap account in the old PSR, either on debit side if there is a loss, or on credit side if it is a gain. We have done that n number of times. Then we have to compute the value of goodwill by any of the methods or hidden goodwill as the case is. And goodwill is generally to be raised and written off. If nothing is mentioned, we always raise the amount of goodwill and write it off as well. Raise amongst the old partners in the old ratio, write off amongst the new partners in the new ratio. Please take care to raise the full amount of goodwill, not just the incoming partners' share in goodwill. Full goodwill raise, full goodwill write off. Raise is the partner's credit, write off is partner's debit. Knock it off, and balancing figure is the adjustment of goodwill amongst the partners' capital. Then any assets and liability taken over. Sometimes the question mentions that some of the partners have taken over an asset or a liability. In that case, you have to debit or credit the partner's capital, and second effect will be in the value of the assets. The difference in the value of the assets will go in the reval account as profit or loss. For example, if a car is there whose value is 1 lakh and it is mentioned that a partner is taking the car at 1,20,000, so partner will be debited, one effect. Car will be increased by 20,000, and this 20,000 will come in the profit in the reval account credit side, because 20 is the amount of gain in the value of the asset. Then sometimes the question mentions something called as a capital adjustment. It mentions that the closing capitals of all the partners should be in the new PSR. In this case, the to balance carried down, that row is finalized. So to balance carried down, the entire capital of the firm will be distributed in the PSR. That will go to respective partners in their respective shares, and the balancing figure, okay, normally the balancing figure is the partners balances of capitals, but if cap adjustment is given, then the the closing capitals of the partners will already be coming in the partners capital account, and the balancing figure will be something else. This something else is to be adjusted amongst the cash bank of the firm or amongst the partners current account, depending on the question. Generally we adjust all these things in through cash account. So either cash is surplus, in which case partners will be paid off the cash. Sometimes the cash is short, in which case the partners bring cash to make the capitals proportionate. Then that is as far as admission of partner. Then comes partner's retirement. It is exactly same like admission, just that a partner is going instead of partner coming. So all things will remain the same. The flow of the accounting will remain the same. The only change is that there is a settlement. There is a settlement of the outgoing partner. So if A, B and C are partners and C is retiring, we have to first settle C's account, because of which we will have to close C's account first. Whatever dues pertain to C, A and B have to bring in cash to pay him or keep the amount in the firm as loan, or sometimes the question mentions 50% is paid and 50% is kept in the firm as partner's loan. So depending on the requirement, the settlement is made, cash, loan as the cases, and then you balance A and B's capital. And sometimes the question may also ask us to have capitals proportionate. As usual, follow the things that we normally follow in admission. The closing capitals of the partners will be in PSR, and the balancing figure, either A pays B or B pays A, or it is simply paid in cash, or it is simply transferred to current account, depending on the question's data. Alright, then during the partners settlement, if it is mentioned that there is a proportionate capital, then the continuing partners may bring in money to make their partners to make their capitals proportionate, or they will have to withdraw money to make their closing capitals proportionate to their PSR. So all in all, there is no new thing to be learned in retirement as compared to admission. The only thing is that one partner is coming as far as admission is concerned, and in this case there is an outgoing partner in case of retirement. So here in case of a raise and a write-off, raise will happen between three partners because old partners are three, and write-off will happen between two partners because new partners are two, because one is retiring. In the case of admission, raise will happen between two partners because two partners are old, and write-off will happen between three partners because three partners are new. So don't learn the numbers, raise between 2, write-off between 3, or raise between 3, write-off between 2. It's always old and new. Depending on the admission or retirement, the number of partners will change as far as old and new is concerned. That is as regard as retirement. Moving on, the chapter's next part or chapter's last part is death of partner. Exactly same like retirement, because that also included a partner going out. Here also a partner is going out, just that retirement can be planned. So generally retirement happens on the first day of the new accounting year. Death obviously cannot be planned, so death will happen in the middle of the year. In that case, the outgoing partner, the outgoing or the dying partner will have to be, his accounts will have to be settled. What all is included in his settlement? 1 is equal to capital. So whatever amount is lying in his capital account, that has to be paid obviously. Obviously all these amount can't be paid to him because he's died. We pay his representatives or legal executives. So capital has to be paid. Interest on capital from the beginning of the year till the date of death, 3 months, 4 months, 5 months as the cases, that has to be paid because he was a partner in the firm for the first 4 months of the year prior to his death. Then comes goodwill. Goodwill is normal, raise and write off. Methods will be given to us in the question. So you simply raise and write off, or simply raise and give him the credit of his share of goodwill because he was a partner in the firm in the first 4 months, for example. So that has to be credited to the dying partner. Reval profit, reval losses as usual. The firm will have to carry out an assets and liabilities revaluation. The revalued numbers will be given to us. All we have to do is give him his share in the revaluation profit up to the date of death. Profit share up to date of death. This is something new, because generally retirement happens on the first day of the year, so we can't find profits of one day. In the case of death, if death has happened after 4 months, then he was a firm's partner for those 4 months. So whatever profits the firm has earned in those 4 months, his share has to be given to the legal executors of Mr. C or whoever has died. So that is his share in the profits. Any share in something called as joint life policy. The firm may take a joint life policy. So in the event of death, the firm is going to get the entire policy value. So whatever is his share has to be given to his legal executives. So all these are to be settled in case of a death of a partner. Now, joint life policy, there were 2 or 3 methods for accounting for the same. One is the profit loss method, where the premium was charged to the profit loss account. In this case, whatever is the policy value, this is more like a firm's gain. It will go in the firm's P&L, or it is going to be directly going to partners in the PSR, because it is the firm who had taken the policy. Whatever is the premium was paid by the firm, that means everybody has paid the premium in their PSR, in which case whatever policy value is received goes to respective partners in the PSR ratio. Sometimes the premium is to be taken as an asset, in which case the premium content keeps on coming in the balance sheet as an asset, and some amount is written off so that the policy can be shown at surrender value. The amount that is written off comes in the P&L, which means the policy value is shown in the balance sheet asset side at surrender value. When the policy matures, there is a gain, and the gain content will be going to partners in the ratio of the PSR. So basically treat policy like an asset. The entry is cash account debit because cash comes in, the policy goes out, so credit the policy with the surrender value, and the balancing figure is the profit on joint life policy, and this profit goes to partners in the ratio of their PSR. Similarly, you have something called as reserve method as well. This is exactly same like my provision for depreciation method, where you maintain a reserve for the amount that needs to be written off from the P&L. So rather than reducing the value of the asset like the previous method, the amount is credited to a reserve, exactly same like a provision for depreciation method. Reserve will keep on coming in the balance sheet for the amount with which the policy has to be written off, so that the net amount is shown at the surrender value. What do you mean by surrender value? If there is a retirement, if there is a retirement and there is no death, then in that case the policy is surrendered. You will not get the policy value, but you will get the surrender value. And once the policy is surrendered, you will not have the entire policy gain. Whatever is the surrender value, that is the amount with which you need to credit the partners depending on the method used. Only in the event of death, will the firm get the policy value. If the policy is surrendered in the absence of death, then in that case we only get the surrender value. That is how you have the joint life policy method. Now, before we close the revision of this chapter, I'll simply talk about how to compute the new PSR. Sometimes the question mentions new PSR, sometimes new PSR is not given, sometimes only the sacrifice ratio is given. So there are different methods in which PSR is to be found out. Very important. So we will discuss this directly. We'll discuss this directly from the ICAI's module. So ICAI's module is here. So in this last couple of minutes, we will simply discuss how to compute new PSR. Very, very important. So please be a little attentive. All right. So we are discussing how to compute. The new PSR. Very important. So let us start. So the ICAI has given one common example. The example is the fact that there are 2 partners, A and B, and they share profit losses in the ratio of 3:2. So can I say this is the old ratio? Yes, so this is my old ratio, and C is the incoming partner and his share is 1/5. Alright, so let's move on. So case 1. Case 1, when new partners share is given, but the question is silent about the sacrifice made by the old partners. In this case, whatever is the balance share, that is again shared by the old partners in the PSR. That's my assumption, which means if the new partner's share is 1/3, oh, they have given the example differently. Oh, the example here was different and the numbers here are different, so we'll take these numbers only. This is my old PSR and 1/3 is my new share, 1/3. Alright, so if the new PSR is 1/3 or new partner's share, then the balance shares appears to be 2/3. Then 1 minus 1/3. This 2/3 is to be shared by A and B in the ratio of 3:2. That's 3/5 and 2/5. So 2/3 into 3/5 and the same 2/3 into 2/5. This is how you get the shares of the old partners. 4/15, 6/15, and 1/3 can be written as 5/15. That is what is the new PSR then? 6:4:5. This is how you compute the new PSR in case the sacrifice ratio is not given. It is to be assumed that the remaining share is shared by the partners in the ratio of their PSR, old PSR. Coming to case 2, hope the case 1 is clear. This is one of the most common methods which we have done in classroom section as well, where it is not mentioned that what is the ratio of sacrifice. Moving to case 2, when the new partner purchases his share from the old partners in a particular ratio. So here the question will mention what is the ratio in which the incoming partner is taking the shares from the old partners. Take an example. Two partners, PSR 3:2. New partner, the share is 1/3 and he gets 1/9 from A and 2/9 from B. So 1/9 and 2/9 appears to be 3/9, which eventually is 1/3. So it is mentioned what is the ratio, what is the sacrifice content. So we can find the new PSR by simply subtracting the sacrifice from the old ratio. For example, 3/5 was the old ratio of Mr. A and 1/9 is sacrifice made by A. So 3/5 minus 1/9, whatever cross multiplication happens, you get the new PSR or the new share in profits of Mr. A. Similarly, the old ratio of B was 2/5 and his sacrifice is 2/9. So 2/5 minus the amount of sacrifice will give us the new share in profits of Mr. B. Since the common number or the common denominator is 45, we will try and express the new partner share also in terms of 45. So 1/3 is into 15. So 15 by 40, one new PSR 1/9. So we'll do it 1/9. Oh yeah, 3 new C's new share is 1/9. C's new PSR is 1/9. No, something is wrong out here. 5/45. What is into third? 15/45. 1/3. 1/3 share in the future profits. Something is wrong out here. 22:8. 22:8 is to 5 is 35. Something is wrong for sure. 3/5 minus 1/9, 27 minus 5, 27/45, 8/45. Oh yeah, this is 15/45. This is wrong. This is wrong because his share is 1/3. Expressing 1/3 in terms of 45, we'll do into 15 and into 15 appears to be 15/45. So the new PSR is 22:8:15. The ICS study mat appears to be having some mistake. So this is how you find the new PSR. 22:8:15. 22 plus 8 is 30. 30 plus 15 is 45 and 15/45 is 1/3 and that corresponds with 1/3. Alright. So when the new PSR is given and the sacrifice is given, simply subtract the old PSR from, simply subtract the sacrifice from the old PSR and you will get the new share in the profits. So please take care, there is a mistake in the ICI solution. So this is how the new PSR looks like. This is wrong. Alright, let's go to the next case. When the old partners surrender a particular fraction of their share in favor of the new partners. This is the third type of data that will be given, in which case you have to find the new PSR. Let's take an example. A and B are partners in ratio of 3:2. New partner is a C, that is okay. A surrenders 1/3 of his share and B surrenders 2/3 of his share in favor of C. So C's new PSR is not given. They have simply mentioned what am I sacrificing. So whatever is the old PSR of A and B, we know the sacrifice content. He is sacrificing something from their old share. So how do you do that? A surrender is going to be 3/5 into 1/3. 3/5 is his old PSR, and 3/5 into 1/3 is what he is surrendering. So he is surrendering this much, and 2/5 into 2/3 B is surrendering this much, because the question clearly mentions that A is surrendering 1/3 of his share. So A's share into 1/3 is his amount of sacrifice, and B's share into, or B's PSR into his share is his sacrifice towards the incoming partner. So here we have found out the amount of sacrifice. Once we have found out the amount of sacrifice, what we do is old share minus sacrifice, and we get the amount or we get the share in the profits. Similarly, old share minus the amount of sacrifice, we get the new share in the profits. Since 6/15 and 2/15 are expressed in terms of 15, we'll express everything in terms of 15. So 6/15 plus 2/15 appears to be 8/15, which means the remaining or balancing figure is 7/15 to make it 1, because 6 plus 2 plus 7 is equal to 15. The entire share should correspond to one full share. Alright, so this is how you compute the new PSR if how much sacrifice they are making is mentioned as a percentage of their, or as a share in their old share in profit. So he was surrendering 1/3, but 1/3 of what? Of his share. So his share into 1/3 is his amount of sacrifice, and sacrifice minus the old share in profits becomes the new PSR. Alright. Next is case 4. Case 4. A and B are partners in PSR 3:2. That's my old PSR. They admit C for 1/5 share in the profits, which he acquires entirely from A. So in this case, the incoming partner is taking or buying his share only from A, which means B is not sacrificing at all. So whatever is the sacrifice content that is made by A, so A's PSR minus 1/5 is flat computation of A's new PSR, and B's PSR will continue to remain the same as it was before the admission. So old minus 1/5. So old is equal to 3/5 minus 1/5 is the amount of sacrifice, and that is how you get the value of the new share in profits. Since B has not sacrificed, his share remains the same at 2/5. So his old PSR was 2/5, the new PSR is also 2/5. Since A has sacrificed this 1/5, the entire 1/5 becomes the share of Mr. C. So 2:2:1 is the new PSR in which all the three partners are going to share the profits. In this case, only one person has made the sacrifice. B has not made the sacrifice because it was mentioned specifically that B is not making any sacrifice. The entire share of the incoming partner is acquired from only Mr. A. It is only A who has made the sacrifice. Moving on, case number 5. When the new partner acquires his share from the old partners in a certain ratio. So let's try this. A and B are partners in the ratio of 3:2, and C is admitted for 1/3 share. I think there is a mistake here. This 1/3 is actually 1/5. Alright, so C is coming in for 1/5 share, okay, which he acquires from A and B in the ratio of 2:1. So 1/5 is the new share, out of 1/5, 2/3 is given or coming from A and 1/3 is coming from B. 2/3, 1/3 is coming from this number of 2:1. So 1/5 into 2/3, this content is coming from A. This is A's sacrifice. 1/5 into 1/3, this content is coming from B. This 1/3 and this 2/3 is nothing but 2:1 coming from here. Alright, and this 1/5 and this 1/5 is the share of the new partner. Alright, so we have got the amount of sacrifice. So old minus sacrifice is the new ratio. Old minus sacrifice is the new ratio. 7/15 and 5/15 is expressed in terms of 15. So this will be expressed in terms of 15. That is nothing but 5 by it's 1/5, right? So this is wrong. As I mentioned, something is wrong out here. C's share is equal to 1/5 into 3/3, because we need everything in terms of 15. That is 3/15. So new PSR is 7:5:3, making it 15. Alright, in this case the new PSR was given, and how much share is coming from which partner, that we had to compute, and old minus the amount of sacrifice is my new share in profits. Alright, that is how we have done this as well. And sometimes the question directly gives the new PSR. This appears to be the old PSR and this is the new PSR. In this case, if the amount of sacrifice is to be found out, it is nothing but old ratio minus my new ratio, and you get the amount of sacrifice content. So if the question does not mention the new PSR fully, then in that case you have to compute the new PSR in 5 different ways. Case 5 was discussed the latest. So there are 5 ways to compute new PSR. This is how you compute the new PSR when the amount of sacrifice is given or when it is not given, depending on the data that is given to us in the question. This marks the end of the revision for this chapter. That was nothing but partnership accounts. So we have discussed the chapter's first part being a basic introduction to partnership. We have discussed about goodwill, we have discussed about admission of partner, we have discussed about death of partner, we have discussed about retirement as well, and we have also discussed about the methods to compute the new PSR. All in all, this is what the chapter is there. Very important chapter. Hope you guys have understood and hope this has refreshed the entire chapter. Alright, in the next session we'll be starting with a new chapter. In all likelihood we'll start with a non-profit organization. Alright, I'll take a small break here, and in the next session we'll be starting with a non-profit organizations last day quick revision. Alright, see you guys. Bye bye.